Every trader has heard the oldest rule in the book, trade with the trend, but almost nobody can answer the question underneath it. What is a trend? Not a feeling, not a line you sketch by eye, but a thing you can point to and prove. The answer is market structure, the lens every other lesson quietly assumes you already own. Once you can read it, a chart stops being a wall of random candles and starts telling you a clear story: who is winning, which way price wants to go, and the exact moment that story changes. In the next few minutes you will learn what a trend truly is, how to market in seconds, the 3 states every market is always in, and how to spot the instant a trend breaks. On 3 real stocks, 1 step at a time. Let us build it from the ground up. Before any real chart, here is the whole idea on one simple diagram. Get this picture, and every chart after it reads itself. Start with the single building block everything is made of, the swing point. Look at how price actually moves, never in a straight line, always in a zigzag of pushes and pullbacks. Each peak where price tops out and turns down is a swing high, each valley where it bottoms and turns up is a swing low. That is it. The peaks and the valleys, and a trend is nothing more than the pattern they make. So here is the first pattern, an uptrend. Follow the peaks, each swing high is higher than the one before it. Now follow the valleys, each swing low is higher too. Higher highs and higher lows, a rising staircase. And the meaning is simple and powerful: buyers are in control. Every dip is bought sooner, at a higher price than last time, the higher low, and every push runs further than the last, the higher high. As long as that staircase keeps stepping up, the trend is up. This is the picture you want at your back when you buy. Now flip it over. A downtrend. Same idea, upside down. Each swing high is lower than the one before, and each swing low is lower too. Lower highs and lower lows. A staircase stepping down. Here sellers are in control. Every bounce dies sooner, and every drop digs deeper. As long as it keeps stepping down, the trend is down. Your cue to sell with it, or simply stand aside. And the third state, the one most traders fight and lose to? A range. Here the highs are all about equal, and the lows are all about equal. Price just bounces between a flat ceiling and a flat floor. No higher highs, no lower lows, neither side is winning, so there is no trend to trade, and the honest move is to wait for a break. Now the most important moment on any chart, the break of structure. This is how a trend ends, and it is the one thing that turns reading structure into real money. Watch our uptrend. The rule that kept it alive was simple: each dip made a higher low, so that higher low is the line in the sand. While price keeps making them, buyers stay in charge. But here, price pulls back and, for the first time, drops clean through the prior higher low instead of bouncing above it. That broken higher low is the alarm bell. The staircase just lost a step. The next bounce makes a lower high. The next dip a lower low, and the trend has flipped from up to down. That failed higher low was your earliest warning, the moment to stop buying and protect your profits. So that is the entire foundation. Swing points build the staircase. The staircase tells you up, down, or sideways, and a broken step tells you the trend has turned. Now let us read all of it on 3 real stocks. Our first example is the one you most want to find, a clean, healthy uptrend. This is Exxon from the autumn into the new year, and we read every chart the exact same way. We do not guess, we do not feel. We mark the swings first, then we read the staircase they make. So step 1, find the swing points. Ignore the noise and look only for the turns. Here is a valley where price bottomed and turned up, a swing low. Up here, a peak where it topped, a swing high. I am circling each one as we go: the lows along the bottom, the highs along the top. Train your eye to see only the peaks and valleys, and the chart goes quiet. Now step 2, read the pattern, starting with the lows. Follow them left to right. The first valley is down here, around 110. The next stops higher, near 112.5. The one after that higher again, around 114. Each dip is bought sooner than the last. Those are higher lows, and they tell you buyers are getting aggressive, refusing to wait for a discount. Now the highs. The first peak tops near 117, the next pushes to almost 121, and the last breaks out to 126. Higher highs, stacked right on top of those higher lows, both the peaks and the valleys climbing together. And that is the entire read. When I connect the rising lows with a line, you can see the staircase plainly. It steps up and up and up. Higher highs and higher lows, the textbook definition of an uptrend, and now you can prove it on the chart instead of just feeling it. And the lesson is the simplest one in trading: when the staircase is climbing, you look to buy the dips. You trade with the structure, never against it. Our second example shows the most valuable moment in this whole lesson, a trend ending and a new one beginning. This is Salesforce, early in the year, and it starts, as they always do, inside an uptrend. Look at the left of the chart. Price had been making higher lows, and this one near 219 was the most recent, the last higher low of that uptrend. Remember the rule from the diagram: the higher low is the line in the sand, and while price keeps bouncing above it, the buyers are still in charge. So I am marking that level, 219, because it is the price that defines the trend. Now watch what happens next, because this is the whole point. Price rolls over, comes down to that line, and instead of bouncing, it slices clean through and closes well below it. The last higher low just failed. That is a break of structure, the single most important signal a trend can give you. The staircase that had been stepping up just lost a step. The alarm bell is ringing. Buyers are no longer in control. And once you see that break, the rest unfolds exactly as the diagram promised. Watch the next bounce. It tops out around 201, well below the old peak near 236, a lower high. Then a new low beneath the last one, a lower low. Another bounce, another lower high, another drop, another lower low, all the way down toward 163. Connect those falling peaks with a line and the new staircase is obvious. It steps down and down and down. Lower highs and lower lows, the textbook definition of a downtrend in plain sight. And here is the practical gold. The trader who knew that higher low at 219 was the line in the sand got the earliest warning to stop buying and protect profits. The trader who ignored structure kept buying every dip all the way down. Our third example is the state that traps more beginners than any other, a range. This is Visa, across late winter and spring. We read it the same way: mark the swings and ask, is this staircase going anywhere? Look at the swing highs first. Here is a peak near 322. The next major peak, also about 322. And the one before, right around the same place. The highs are not climbing and not falling. They are all about equal, tapping the same ceiling. I draw a line across them, resistance at 322. Now the swing lows. Here is a valley near 297, and the next one, also about 297. The lows are equal to, resting on the same floor. So I draw a second line there, support, at 297. And now the picture is unmistakable. Price is trapped in a flat box, bouncing between a ceiling and a floor. This is the key recognition, so let it land. There is no rising staircase and no falling staircase. Equal highs and equal lows mean neither side is winning. A stalemate with no trend here at all. And this is exactly where undisciplined traders get chopped to pieces, buying near the top and selling near the bottom on a chart going nowhere. The structure is telling you the honest truth: there is nothing to trade in the middle. The patient move is to wait for the box to break, and eventually it always breaks. Watch the right side: price pushes up and closes decisively above the ceiling, out of the box entirely. That breakout is the transition, the range is resolving, and a brand new trend is trying to begin. From here you go back to step 1 and watch for the next swing low to come in higher, confirming a fresh uptrend. Range, then break, then a new staircase. The cycle starts over. Read exactly the same way. Let us lock the whole thing into one checklist you can screenshot and run on any chart. Just 5 lines. 1. Mark the swings. Before anything else, circle every peak and every valley. You cannot read a trend you have not marked, and this one habit does 90% of the work. 2. Rid the lows. Are the valleys rising, falling, or flat? Rising lows point to an uptrend, falling lows to a downtrend, and flat lows to a range. 3. Rid the highs, and make sure they agree. In a real uptrend, the peaks rise with the valleys. In a downtrend, they fall together. When the highs and lows disagree, you are probably in a range or right at a turn. 4. Watch the last swing low in an uptrend and the last swing high in a downtrend. That one point is your line in the sand. The day price breaks, it is the day the trend is in danger. 5. Trade with the structure. Buy the dips while the staircase climbs, sell while it falls, and stand aside when it goes flat. With the trend, never against it. That is it. Run those 5 checks on every chart, and you will always know who is in control and which way to lean. If this made it click, subscribe. We build a new skill from the ground up every week. And that is market structure, the foundation every other trading skill is built on. A trend is just a staircase of swing points. Higher highs and higher lows is up, lower highs and lower lows is down, and equal highs and lows is a range going nowhere. And the moment a swing low breaks in an uptrend, the trend is in danger. Your earliest warning of all. Here is your homework. Open any chart and mark every swing high and swing low you can find. Then read the staircase out loud. Is it climbing, falling, or flat? Find one trend that is still intact and one that has just broken its structure. Do that on 10 charts this week, and reading any market will become second nature. If this gave you the foundation, subscribe. We build the next skill from the ground up every single week. See you in the next one.